There is a fearlessness in the market. So says George Cipolloni of Penn Mutual Asset Management. He joins me today. I'm Lisa Bernhard with Reuters. All right, George, you say there is an absence of fear in the markets, and this is despite stubborn inflation, despite high rates, despite the fact that we may still slip into a recession at some point over the next 12 months. So why the fearlessness?
So the fearlessness, the way we're seeing it is through all the volatility indexes. If you look at the VIX of the S&P, if you look at the VIX of the bond market and the VIX of the Nasdaq, of course, you see absolute low levels of fear and volatility. And so one of the main reasons is that, look, we have a really good job market right now, a strong job market. Earnings came in pretty good. Now we can get into the weeds in terms of talking about why they were good, but they were good. And then there's also a wealth effect. I think that is a big deal. Asset prices beget confidence. And I think a lot of people do feel that effect. And so I think for those three reasons, people are complacent.
We have more key economic data coming this week. We have a revision on first quarter GDP coming Thursday, and we have the personal consumption expenditures price index that comes Friday, the PCE, of course, the Fed's preferred inflation gauge. What are you preparing for in both the numbers and the market reaction?
Sure. So in terms of the market reaction to GDP, it's been pretty tame over the past few quarters. I do think the big one is the PCE. Now, the PCE peaked out at around 6%. It had fallen all the way down to 2%, which was great. But now it's resurged a little bit here, and it's back up in the expectations around 3.7%. So we would definitely not want to see a much stronger number than that in terms of the PCE, because as we've seen today already, the Treasury market has been weak, and we wouldn't want to see it much weaker or rates much higher from here.
So speaking of rates, the Minneapolis Fed President Neil Kashkari warned yesterday that a rate hike is not off the table. If that were to happen, how, as a portfolio manager, does that change your outlook on the economy and on markets?
If the Fed does really consider a hike, I think it would send two signals. Number one, that they are absolutely intent on beating inflation, which they might have to be. Now, that's the one side, which I think is actually admirable. On the flip side, it will not be good for the markets. It will be a wow moment. It will be a moment where, again, we had thought that there were going to be 6 to 7 cuts over the next year or so, and now we're already down to one or two. So an actual hike in the midst of us expecting still one or two cuts the rest of this year would be a wow moment for the markets, and probably wow in not a great way.
All right, let's turn to some company news that we saw today, because it was another big oil merger in ConocoPhillips buying Marathon Oil. So this comes on the heels of Chevron agreeing to buy Hess and Exxon buying Pioneer in October. Why are we seeing so much consolidation in the oil space?
So in terms of the consolidation in the oil sector in particular, I do think there's a few reasons. Number one, the U.S. has gotten to be incredibly efficient at producing oil, and we're hitting record numbers in terms of production. But if you look at the rig counts over the years, the rig counts keep coming down. They peaked in 2014, and the last two peaks have been lower. There's only so much you can drill for, and I think we've kind of reached our peak efficiency. So the only way to really get some more good moves out of these stocks and in this sector is some consolidation and more efficiency on the corporate expense side of it, quite frankly.
In earnings news, we saw Dick's Sporting Goods and Abercrombie and Fitch have very strong earnings, discretionary brands there. Why are they so strong at a time when we're seeing consumers cutting back on goods?
So we're seeing a lot of differentiation across the consumer discretionary sector. If you look at the ones that are doing well, they seem to have addressed a specific strategy to identify their core consumer, and they're hitting it really hard and really well. So Dick's is a great example. Abercrombie and Fitch changed their strategy a few years ago, but they are outperforming just about every other mall-based retailer today. So one of the things is, if you do well online, you tend to have done better versus just be a physical store, and both of those companies have done that. And then again, what offerings are they providing for the consumer that provides value? One of the big keys that we've heard on all of these calls is the fact that the consumer wants more value, and it's one of the reasons why Walmart has done so well relative to other companies too. So it's either price or you're going to have to differentiate. And Dick's and Abercrombie so far have done well at differentiating.
I have to, of course, throw in an NVIDIA question for you. The 10-for-1 stock split is not coming until early June, but that's actually soon. Do you expect that retail investors will rush in, and should they? Or is there another AI play that you think they should be making?
Yeah, NVIDIA is really an incredible story. Obviously, their growth is spectacular. It's really being driven by just a handful of customers. So you really have to watch that. Now, the stock split, there are many studies that will show that stock splits tend to beget higher stock prices. But again, even though the net effect should be negligible. But anyway, going back to NVIDIA, I think as a value investor, it's certainly not the way to play it. I do think there are different ways to play this AI trend. I think one of them, quite frankly, is utilities, power generation companies. They all should benefit from the demand for energy created by AI companies.